Hey,
Wow.
welcome, Dionne Bass. Hey, you said wow?
Wow. That was an entrance.
Oh yeah. Especially for you, we want to make you feel special today. So, Dionne Bass, welcome to Lending with Purpose. These are conversations that we have with clients and friends, intros to various forms of information and professionals like yourself, resources that we use, that we look for, that we never knew existed or wanted to learn more about. So, how are you today?
I am good, and I am honored that you invited me on the show.
Oh yeah. Thank you. Actually, um, we've been seeing each other on the LinkedIn platform for a good bit, and you actually just commented on a post that I put up, and I said,
Yes.
you know what, this timing is perfect, and I sent you out the link, and I was thinking to myself, like, she doesn't know this, but I would really love to have somebody on this Thursday because I've taken a bit of a break, and this is the first one I've been back. I think I've spent this past month in July really focusing on some hires that we made, getting them up and running, really
Oh,
refocusing on the team and such. And so I wasn't pushing to get a bunch of people on, but I'm like, all right, I want to get back going in August. And you picked the perfect date because you picked today. And I'm like, yes, here we are. I can get back faster than I really wanted to. So so yeah, thank you for doing that. And real quick, I wanted to share with you a quick story that I have in regards to underwriting, because we're going to talk about, like, today, what does it look like, and what does it mean when your loan is in
gosh.
underwriting.
Oh, gosh.
And so recently I had a situation where I really thought that I had overpromised someone. This was recent, meaning last year,
Okay.
and that someone was buying a house, right? But they did a non-contingent offer on the sale of their house. And so we worked everything out, but um we miscalculated their income. So now the DTI wouldn't carry it. So no matter how they slice it, the DTI was going to be too high because they didn't have enough income to carry keeping the house that they currently live in and buying the new house, right? So they had to sell it first. I talked to an underwriter about this. I was explaining to them, like, how I thought that I had messed up and made a mistake. And they were like, well, they started to ask me a series of questions. And one of the main questions is that they had to me for me, Dion, was, is the existing home, is that under contract? I'm like, yeah, it is. And they're like, okay, well, does this particular contract, has the buyer uh, met the financing contingency? And I was like, yeah, I'm pretty sure they're beyond their financing contingency. And they said, well, there's a rule that if they have met their financing contingencies, all contingencies have been met, like appraisal, financing, all that good stuff, that we don't have to count this debt against them. I can't. I think it was It's Fanny. I can't remember if it was Fanny or Freddie. She's looking at me like, and it was a real thing. And I talked to some of my industry friends, and they're like, "This been around for a while. Like, you didn't know that?" And I'm like, "No, I didn't actually." And so, long story short, we were able to use that because the realtors were able to provide documentation showing that the all the financing contingencies had been met, and and that we were able to remove this debt, and then it fit inside their debt to income ratios, which would allow them to be able to purchase that home. And so
Wow.
my saving grace was the fact that I had a conversation with the underwriter. I spoke up, and I didn't treat them like they were the adversary.
Yes.
And we worked together to make it work for the particular borrower. And so, for those of you that are listening out here, Dion's been in underwriting for a good while. I'll let her tell you more about that. But they are not the big bad wolf behind the curtain that's looking to kill your loan and not approve these loans. When we communicate and work with them, As long as it fits the guidelines, they'll work with us to be sure that we can successfully help more homeowners get into homes. So, with that said, Dionne, I would love for you to tell us because I haven't mastered the art of this enormous introduction yet. I'm getting there, and I will get there. But you're going to do a much better job than I promise you. So tell us who you are, what you do, and then we'll get started.
Before I do that, I just want to say that I cringed when you said you had an underwriting story because I didn't know what you were going to say. So I am just really happy that you found a kindred spirit that there are people behind these loans. You are not a loan number. There are people behind these loans, and I would say that most underwriters feel that way. So thank you for that great story. But I have been in the mortgage industry for, my God, my son will be 30 this year, for about 27 years. And I actually worked my way up. I was not one of those college graduates that came in and started underwriting. I was telemarketing in the back room, getting leads. And then I got promoted to process loans. Then I got promoted to be a processing manager. Then I got promoted to be an underwriter. And this has been throughout the years. Now I mentor people. Excited to know that you brought some new people in. Reach out to me and I'll do a class for you. But that's that what you were doing with your people, taking that month off. That's my passion, and I love to see people like you put that type of time inside of your people, as opposed to just dropping them off and letting them kind of just go out there and do their own thing. But that's kind of what I do. Actually, the underwriter was born through a desire to bridge the gap between sales and operations. So I'm glad to see that that gap has been bridged for you.
Yeah, let's actually talk about that. I've been in the industry not quite as long as you, but it's going on, was it like 18 years now, almost all 19 years or so, right? About 18. And so what I've found at some companies, there's been other companies where we've changed sort of the culture around it. It was you were either in sales or you were operations, one or the other. And it was
Yeah.
like sales has a way of thinking, operations. I start hating the word ops when I hear
Yes.
the abbreviation of operations. When I hear ops, it makes me cringe, like what you mentioned, because
Yes.
we would, and from a sales perspective, blame, I guess, for lack of a better word, the operations department. Then operations, because they're being piled up on, would say, well, if they would do better over here,
See. Yes.
then I'd be able to do my job better. And so then what would happen is everybody's kind of on eggshells, right? Or you don't do your very best work either here or there. And then you aren't collaborating to make it the very best experience for your internal users, right? Which then creates a an even worse experience sometimes if they feel it for the consumer. And it's really all
Yes.
about the consumer and the
Yes.
relationships out, in those relationships. And so um let's talk about what that means, bridge the gap, because I feel like companies that don't necessarily look at, I mean, because you do have to differentiate the two, right? Because
Yes.
there's a front end and a back end, but you do collaborate. And so
Yes.
uh tell me about that, and then I can add my 2 cents later as well about it. But talk to me about bridging the gap between sales and operations.
One of the main reasons why it's so important to me is because of what you just said. The bar ends up being the loser. I'm so busy trying to point the finger. I'm so busy trying to get the blame off me so I don't get in trouble that we're never solving the problem. And for me, over the years, that's why I was always the quote unquote common sense underwriter. Even when I worked retail, I worked wholesale. I picked up the phone and called the brokers. Listen, what's going on? Tell me what you need. I made the phone calls because sending a file back 9 times because people keep sending the wrong condition, who are you helping? All we're doing is prolonging this closing and torturing the borrower. So for me, bridging the gap means putting your feelings aside and trying to find a solution. The processor is always the person that's being pulled back and forth. Why? because they work so closely with the originators. And unfortunately, they're usually overworked and sometimes they do miss stuff. I'm going to go even deeper and someone's going to get mad, but I don't care. Sometimes underwriters miss stuff. We got to be accountable for our actions so that we can move forward and fix whatever the problem is with the file.
And what's an underwriter's job? Like, what is your responsibility? So one thing I will say for everybody that's listening out there, I do not have the authority to approve a loan. There's really only one person in the entire company that's got the authority to approve a loan. Is that right?
I wish
To
I
de-
could say
to
that
de-
was true.
so to so so to deny or approve a loan. So tell us what an underwriter really is, like what the responsibility of an underwriter is. And so for those of you that haven't gone through the process or aren't so familiar with the process, when we do mortgage loans, it's our responsibility to compile documentation in order to submit to an underwriter or a person within an organization. To make a decision and to validate the information that we type into the computer, right? And to validate the documentation that we provide. And so I asked a question and I kind of answered it, but I want to hear it from Dionne. Like, what is an underwriter?
So the techie term is we assess risk. Okay. The simplified version of that is that new lovely 25-page application that they've come out with. We are verifying all the information on that. That is like the simplest way. And what is that divided into? The four C's of credit: credit, income, assets, collateral. Okay, we're looking to verify if your credit is within certain parameters. We're looking to see if you actually earn the income that you say you earn. We're looking to see if you actually have the assets that you say you have. And we're looking to make sure that that property that you are purchasing or that you are refinancing will hold its value. Because remember, you're using that house as collateral. I'm not sure if I gave that a good breakdown and I go too quick.
No, that was perfect. I was that's going to be a gem. That's actually probably going to be one that we pull out from this conversation and use it because a lot of people need to understand that. Um, we and actually I take out sometimes the collateral piece. I'm
Mhm.
going to start adding that in, like income, assets, and credit. That's the easy thing for us, right?
Right.
Um, and so there's a four-legged table. So you take one out, the table could potentially stand, right? But
Mm,
in this case, if you take two out, chances of the table standing, it's going to be very tough.
that's the truth.
Is that sound about right?
That is the absolute truth.
All right. And at what point, what does it look like when a file goes to underwriting? Like at what point should we at what point do you see the file?
So when by the time the underwriter gets the file, technology has I want to word this carefully. Technology has done a little something different to the process. So, depending on the size company, when we get the file, a lot of the documentation for the credit, the income, the assets, and the collateral have been either ordered or on their way, and we have like a little sneak peek of it. So, usually when we get the file, we're looking to see if it makes sense. And I can actually give you two really good examples on on income. When I get your pay stub, does your year to date gross income, so all the money that you've made as of August 11th, does it actually support what you say that you make? You say you make $5,000 a month, but all the money that you've made so far is only like $25,000. That doesn't you should have made about 60 or 70,000 so far or 50. You understand what I'm saying? Another good one is you get a verification of employment, and this is my absolute favorite. Not in a good way, in a bad way. You get a verification of employment and a person earns bonus income. But that little bitty tiny box is checked, not likely to continue. I can't use it. No one ever looks at that box. And I like to give that as an example so you can start looking at that box. So those are
I
the two little
always
things
look
that
at
we look
that
at.
box.
Okay. That's
by the
right. You're the
way.
CEO.
Once you've been burned once,
Yes.
you will not be burned again. But I digress. Keep going.
If I were to give an example as far as assets go, um, undisclosed debt is a hot spot. It's a hot spot. And I'm going to tell you why it's a hot spot, because different lenders have different overlays that address that. Some of them are not concerned about it, some of them are. So, what if you've got this consistent payment? What do I mean by consistent? For a purchase, you probably need 2 months bank statements, right? Well, there's a debt that's listed on there that you paid twice in a row. You know, you paid ABC Candy Company $250 in January. You paid ABC Candy Company $250 in February. Now, the average underwriter is going to say, "Is this an undisclosed debt? Did you include this in the amount of money that the borrower is putting out every month?" So we're looking for stuff that could possibly derail the loan, if that makes any sense.
Yeah, no, that makes a lot of sense because you're going into it thinking one thing in regards to the amount of money they make, how much
Yes.
debt they have, right? And if you've made your decision and you don't have all the information and something pops up, then now you have to
Yes.
consider this new information that comes up.
This is true. Yes.
Right. And that's why we tell a lot of people, and obviously you know this, and I'm speaking to the audience, but like be really careful about acquiring new debt while you're going through this process. So before the process, it's simple because we can see it, it's all black and white. But once you get into the process, please don't go and get that new furniture or go buy all these TVs and appliances from Best Buy because they're having a sale.
Yes.
Just wait, because what we're doing is if your credit card balance is $1,000, right? And whatever that payment is, say it's $100 a month, and now you've increased it to $10,000, and now that payment goes from $100 to $1,000. That's $900 a month that we haven't necessarily accounted for. And like you mentioned, Dionne, some lenders will refresh your credit prior to closing to
Mhm.
kind of look to see if you've increased um, your balances and such, right? Some lenders won't, but you
Yeah.
don't want to take that chance, right?
Yeah.
Because everything's always all good till it's not. And then you when you do your application, you're saying that you don't have any undisclosed debt anyway. So you want to be very careful with that. I've had situations where that happened. I have one specific situation. Let me tell you this one since we're talking. Um, I had a young man that was buying a house, Dion, and he um, he was telling me that he was going to use his retirement to purchase the home. And so, as you and I both know, many plans will allow you to borrow up to 50% of your vested balance to purchase a home. It's your money; you borrow it and you pay it back, and you can use it for a one TSP, 401k TSP, 403bs. Many of those plans allow you to do that. Well, he worked with a system that wouldn't allow you to make any withdrawals at all. So we had to pivot at the last minute. He's like, well, remember I said that I could get this money from this account? Well, I can't get the money now. And I'm like, well, okay. And he's like, but I got the money. And I was like, well, what do you mean you got the money? He's like, I went to the credit union. And I'm like, okay, what do you mean you went to the credit union? He's like, well, I went to the credit union and I took a loan out so so that I could use this money to buy the house. And I was like, whoa, 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 whoa. Look, like, no, you gotta, number one, take that money back. Right. And number two, because you can't borrow money in a mortgage transaction, right? Um, but in his particular situation, this new payment was about, I think it was about $150 a month, maybe $200 a month. So his debt to income ratio,
Went
right,
up.
didn't allow him to fit any more debt in there, right? How much
Yeah.
money he makes versus how much he's able to spend at, call it a 50% ratio, didn't
Hmm.
allow him to have any additional debts. So this new loan would have killed his loan and derailed the whole thing. So what he had to do was pay all the money back, thankfully he didn't spend the money. Oh my. I'm so for him. I know he's
Yeah.
grateful that he didn't spend the money. And then um he was able to get a gift from a relative. So he had, I think his mother-in-law or something like that gave him a gift to purchase the home. And so like it's things like that. And the reason I'm telling this story is because that is undisclosed debt, right?
Yes.
And so you want to be very careful of those types of things. And so I don't want everybody to get scared about it. It's just like when you're making these decisions, just consider those things, and the best thing that you can do is to talk to your loan officer, and or if at that point, if you're dealing with a an ops person, operations or
Yeah.
processor or someone like that, tell them exactly what it is that you're intending to do, because it's a lot easier when we're proactive, and it's very hard to be reactive and try to undo the mess that was already made. And so that's when I think, Dionne, the industry and the underwriting gets a bad rap, is because like once it's seen, you can't really unsee it.
Cannot unsee it. You cannot unsee it. That's, I mean, I, I we can tell when we get a loan and it's been someplace else. Let's just say that. And that right there is the reason why, because something could not be unseen. It doesn't mean it doesn't qualify. I don't want you to think that I'm saying, "Oh, that's a horrible thing." Stuff happens. But um, sometimes people are able, if I'm able to use the word that you use, pivot.
Definitely pivot. We have to.
Mhm.
So I call it rule number 35. Like people are like, this is an easy loan. And I'm like, nah, no loan's
Mm-mm.
easy. It doesn't matter. 800 credit score, 20% down. There's always going to be
Mm-mm. Something.
something that comes up. And so, and again, I don't want to make it seem like it's a bad thing, but the something could just be a letter of explanation on, your various addresses and things like that that you might have. So let's speak to that. So we have credit. We talked about income a bit. We talked not much about assets, the collateral piece. That's simple. But let's talk about credit. So like what are you looking for as an underwriter in regards to credit?
Ooh. So refinances are pretty easy. You know what I mean? We're the surprise or the monsters that come out with refinances are what you said, the letters of explanations for the different addresses that may or may not have been disclosed. You own something in another city or you own another property somewhere. Um, my favorite, the letters of explanations for the inquiries where they say that they did not obtain new credit. And like you said, some lenders will pull that credit report toward the end of the loan, and lo and behold, they did obtain another piece of credit. If you have, I'm so sorry. as
Take your
far
time.
as as far as purchases go, I want to be careful when I talk about purchases because I am super califragilistic excited to see these credit scores going down for FHA. How you take a program like FHA that's supposed to be an affordable program and put this credit score so high that no one can qualify for it. That just irritates the stew out of me. So, for different like government programs, we are looking at different credit scores and we're looking for the amount of credit that you have. Okay. So let's talk about the amount of credit. USDA requires you to have USDA is a 100% financing program if you're in a rural area, but you got to have a certain amount of trade lines. Those trade lines can be non traditional, meaning your rent, your hazard insurance, your cell phone bill, your life insurance, your daycare fees, or you could have three liabilities on your credit report. Your Capital One card, your J.C. Penney card, or your Walmart card. And we're looking for 12, I think one for 24 months and a couple for 12 months. So a 12-month history, which is why the non-traditional is really, really great. So we're looking at the length of your credit, if that makes any sense. The automated system might pull you in and you don't have to worry about that. But when you do have to do a manual underwrite, that is what we're looking for.
Got it, got it. And then like what are some things on your Yeah, there we go. So let's talk about that. The manual versus automated, because we typically want to go automated first and foremost.
Yes, you do.
So are you okay with like let's talking about like automated versus manual?
The reason why you want that credit score up, and I am in no shape or form discouraging anybody from purchasing. If you can purchase with manual, please do so. But one of the main reasons why you want automated is because your DTI is higher. You know what I mean? You can go up to 50%, sometimes over 50% when you're dealing with the automated system. With the manual system, you're capped at like 45% DTI. With the manual, they want more documentation. You know what I mean? You might be able to give a pay stub with what do you call it? A pay stub or a W-2 with an automated underwrite. With the manual underwrite, got to get 2 years this, 2 years that. There just is so much more information when we're manually underwriting a loan that's needed. I'm trying to think of something else that would have to go with manual versus automated. Um,
Verifications of rent. There's
Verifications of yes,
yeah,
it's
yeah,
not
like
needed.
that's huge.
That it's
Yeah,
very, very
verifications of rent is
huge.
yeah, it's typically I see that on manual underwrites.
You have to provide a verification if the automated system is not considered your loan. Now, sometimes it might be on there, like for some FHA transactions, but primarily, no, no, not at all. But like
Yeah,
I said,
yeah. And
Sean,
so
I don't want to discourage anybody. If your credit score is low and you qualify, go for it. But there is less
oh yeah,
information you have to provide.
absolutely. But I think that's actually something that gives people hope, because one
Yes,
thing that I always talk to folks about is like this is not like you're applying for a credit card. You know, you apply for a credit card and they're either going to accept you right on the spot, or they're going to send you a letter and say, "Hey, in 7 to 10 days or whatever it is, we're going to make a decision." But
yes,
during that time frame, you don't get to talk to anyone. You don't get to
mm-mm,
explain what happened. There's no additional documentation that you can provide to assist them with making a decision. So when the computer says no, right? The human being, which is the underwriter, has the opportunity to review everything, take into consideration, does this meet the guidelines? And if it
yeah,
meets the guidelines, chances are they'll be able to approve and make that loan for you. So I don't look at that as being a negative thing or discouraging anybody from applying. I just look at it as a way to say, hey, listen, this is a way that we can help more families by doing something like this if it doesn't fit inside the box. And so, real quick, just to kind of uh, uh, sort of dumb it down a little bit, because this is how I learn. I think of the automated system is the computer makes the decision. I type in everything on the application that you mentioned, and the computer, based on the information that was typed in that we provided, uh, has an algorithm and it queries all this information and it's able to make a recommendation based on what's been provided, right? The underwriter then was then our responsibility to collect the documentation to support the information. So if I say you make $60,000, then your W-2s and your pay stubs and everything need to match what I put in there. If I say you have $10,000 in the bank, then we need to have assets and we need to have bank statements to add up to this amount. So as
yes,
long as it can all be verified, then we go with the computer findings. However, there are times where no matter what we type into the computer says, like, no, like, no. So
oh,
it gives you something called a refer.
yes,
And with that refer, as long as it says refer eligible, then the underwriter, it's at their discretion. They can review that file to determine why was it referred, and can we make, because it's eligible, can we make this an approvable loan? So I just wanted to make that very clear, because that's the way I think about this. It's easy for you and us, you and myself,
Yes.
Dionne. We're talking shop. This is what we do every day, all day. And so I just want people to understand that. Uh, what what else did I miss before we move on? We got a little bit more time. I don't want to take a whole bunch of your time, but what did we miss in regards to the underwriting piece before we move into the next thing?
Is the you want to talk about collateral real quick, just so that we cover all
Yeah,
four C's?
yeah, I
Okay,
think that's
so
important.
one of the things that we're looking at when we look at collateral is we're looking to make sure that the property does not only support the value, meaning um, do the properties in your neighborhood, do the properties within at least like a 1 mile radius, are they all appraising for that same value? Are they higher? Are they lower? Do they support each other? But two, health and safety issues. That is so huge. That is so huge. Um, you see properties where you walk outside the back porch and there's no stairs. Or, there's like what do you call it? There's like walls missing, and it's like they're just what we want to know, what that lender, what that investor behind us, because there's always somebody else behind us. There's someone behind you, there's somebody behind me. Can I sell that property? That's like the simplest way that I can actually put it. And don't get me wrong, when the mortgage industry melted down, oh, they could sell those properties, whether they was beat down, broken, or whatever have you. But when we're talking about a live loan that we're financing right now, can I sell that property? Or does it look like, what's the name of that one HGTV show, Zombie Houses? Yeah, we're not
Right.
financing zombie houses. We're financing houses that you can live in right now. Now, I don't know if you know this, but you know that Fannie and Freddie both have um, an equivalent of a 203K loan, right?
Yes, I do. Home style.
The home style and I can't remember what Freddie's is called, but they even do investment properties. So you could do
Yes.
investment or primary. So really good program. So there's programs for that. And I'm so happy because so many people would get frustrated because like you get letters of exclamations that say, well, yeah, I'm taking the cash out so I can make my house safe, but we don't do those type of loans, if that makes any sense. There's a difference between home improvement and a property that's just not livable.
Yep. Yep. No, that's good. 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 I appreciate that. So, uh, ask the underwriter. That's a. I know you do some trainings. And you're
Yes.
licensed with the NMLS to do the state and national trainings and such. You deal with folks like myself who are loan officers or people that are just
Yes.
getting into the business. And oftentimes, especially folks like myself that's been doing it for a long time. I don't profess to know everything, but we think we know a lot. Um, what are some of the kind of questions that you get from loan officers?
The questions that I get the most is on income. A lot of questions on
Okay.
income. A lot of tax returns. Um, you guys tend to just pick a number that you want on that tax return and use that as the income.
Yeah,
Like,
of course we do.
this number
Whatever
looks good.
works.
Yes, this number looks good. Um, what are
We,
the other
yeah, we don't
questions?
care about all the write-offs and anything like that. Like, it
No.
says a number and that's the one we divided by 12 and that's what we're going to use, right?
Yes, yes. Let's just do that. Let's just go ahead and do that. Let me think of something else. It's funny, I should have had some stuff written down. As far
So
as
so
credit, go
income like
ahead.
self-employed though, right? Self-employed borrowers typically.
Self-employed, typically self-employed, but then you got people who are kind of like think about your nurses and your truck drivers.
Ah, yeah,
My
yeah.
my favorite, your teachers.
Yes.
You can get a pay stub from a teacher. It's the middle of the year and they made $1. And you're looking like, what? Where's this money? You got to get the contract. And so it's a lot of it's a lot of back and forth with that.
Even with the teachers, this is important to know. We don't talk about this a lot. Some of them have 10-month contracts versus
That's
12
right.
months.
That's right.
And so you can get snagged with that too as well. So if you're calculating your loan officers, if you're calculating a teacher's income based on a 12-month income versus a 10-month, sometimes you could get snagged by that, and the income might not be enough for
As
exactly
much
what you
as you
think it
think.
is. Yeah, so make sure when you're dealing with teachers, you understand uh, what their contract looks like. If they're because the 10-month is the 2 months out in the summer that they may not get paid, right?
That's right.
So, but many teachers spread it out over a 12-month period so that they can get paid every single month. But you want to really understand that. And I'm only saying these things too it's because I've been snagged by that. Like it's nearly impossible for us to know backwards and
Everything.
forwards
That's right.
everything, and a lot of times it's usually trial and error. Not trial and error, but you learn from any little mistake or any a big mistake that you might make. But uh, think one more question that you might get asked a lot from loan officers or just folks that are getting trained by you.
I will probably have to say, let me see, credit, income, assets. Ooh, this is a good one. Um, do we care about large deposits on business bank statements?
Hmm.
This is how I look at those deposits. Okay, so say for instance they had like $175,000 deposit. Okay, but they normally make about $175,000 a year, and then the regular ones, are regular deposits. They're 2,500, they're $1,000. Am I concerned about that? No. Why couldn't I have just had a good month? You know what I'm saying? Like speak to it. My thing always is I am a avid note taker. Write a note. Listen, I know you see that $175,000. Well, they got a great deal, or they got a great contract or whatever have you. It was a one off, but it is quote unquote not a large deposit. Yes, I've had people email me and say that people are asking them to document large deposits for businesses. But what I always say is just to speak to it. Speak to it, show the underwriter, explain to the underwriter why it's a one-off, and it doesn't quote unquote, it's not a big deal. Or show them their gross earnings. Yes, they had that, but I mean they usually make $1 million a year. How do you think they get to $1 million? It might be spread out or whatever have you. You typically see that like with attorneys and real estate agents, the two that I can think off the top of my head.
That's good stuff. I call that the art of storytelling. Like take a little bit of time before you submit to tell whomever what it is that you're working on. I always ask myself, what is it that I've sold?
Hmm.
Like what is it that I've structured? And then
Oh,
I think about that and I write it out. And then also a good practice for loan officers as well is address in your letter of explanation income, assets, credit, collateral.
that's right. That's
Yeah,
right.
yeah. And so the last question on this, because I know you're busy and I want to get you back to getting these loans approved. We have fewer loans these days, but we're working to get back. The rates are dipping a little bit, and the purchases are getting more active. There've been some inventory that have come back on the market. So we're I'm optimistic about it all because people are still going to buy houses, and we have a very high demand for houses at this point. But like you said, about 30 years, I think you've been in the industry. Is that right?
I said my son will be 30 this year. I've been in the industry about 27 years since he was 3. When I remember
Okay.
him being right underneath the table playing while I was at work
Okay.
working.
All right. So how have you seen things progress over the past 27 years? We recently got connected on a post that I'd wrote about, my why and the reason why, I'm in the industry, to really impact not only, but to impact people of color. And so that's one of the things that, how we recently got connected. And so I wasn't even, there wasn't even a thought in my mind about getting into the mortgage industry before I did. And so like how have things like sort of changed and progressed what do you see? Like, are you optimistic about it for the inclusion and such moving forward? Like, let's end on that note.
I kind of feel bad because I don't really see it. I actually feel like we should be further along. I think that we should. I think that there should be more Sean Williams out there. I think that there should be more people of color that are real estate agents. We're underserved. We're not. We're not. We don't own. Our percentage of home ownership is too small. We need
Hmm.
to finance more of our people. We need to show them how to purchase homes and to stop renting. So, unfortunately, I don't really see much of a difference between back when I started and now. I just see that there are more people of color that are processing, that are underwriting, but we need more people who own mortgage companies and who are real estate agents so that our people will talk and trust them.
Got it, got it. You said that eloquently. I don't know if I could have put that any better myself. No, thank you for asking, because that's, again, like I said, I mentioned that's how we got connected the other day, because I'm very passionate about this. Again, we want to make mortgages for anyone that qualifies. We want to help, but
Yes.
uh um it's very important to the world, to the economy, um to our community, that we understand what we're getting into, but also that we participate
Yes.
in a big way. And so I appreciate those comments. Dionne, what can we do to help you? Number one,
Well,
and then number two, how do we connect with you?
so I need you to tell 100 to 1,000 of your closest mortgage loan originator friends to sign up for their continuing education with me and for any training and development that they might need, their processors, their new MLOs. My website is asktheunderwriter.net. You can find me on LinkedIn, Ask the Underwriter. I am also, of course, under Dion Bass. And you have any questions, hit me up on LinkedIn. LinkedIn is pretty much where I reside. I haven't really been really good at connecting on Facebook because I'm not really a Facebook person. I got to do better with that.
No, it's be where you are.
Yes.
um and just make the best of that. Like I'm actually thinking about scaling back on some of that stuff. Like, I'm not really that good at social media anyway. I do really enjoy LinkedIn. I feel more comfortable on LinkedIn, uh
Yes.
because it's a business platform. I like the way that it's turning into you being more authentic and showing your real self a bit more, but still keeping it professional, right? And so don't beat yourself up over that. Just stay on LinkedIn. That's honestly speaking where a lot of loan officers and you know uh, uh, folks that are going to be transitioning to our industry are there anyway. So I wouldn't worry about it. I wouldn't worry about it. Um, and I just put up there how we connect with you. So here we go.
Oh
One final
gosh.
question. Oh gosh, one final question. You get one person, one question. Who would it be and what would you ask? One question for one person. Who would it be and what would you ask?
If I could talk to one person, it would be Jesus. And if I had to ask a question, um, my question, I don't know, how could we do better? How could we do better? That's all I got for you.
Yeah, I'm sure that would be a long conversation. That's a great
Yes, it
question
will.
too. You get an earful on that one.
Oh yes.
Well, and since you ask,
Yes. Well, it was
that's amazing.
a pleasure, a pleasure. Thank you so much for having me on. Thank you so very much for reaching out. I hope that we keep in touch because I would love to talk to
We
your new people.
we will. We are in the process of needing to get the continuing education done.
Cool.
So I will be reaching out to you. And so you have to hold me accountable for that because I said it publicly. So I'll be
Yes.
reaching out to you to see how to get training on that, because the CE stuff is due over the next couple of months here, so that we can renew our licenses for next year.
Sounds good.
Yeah, yeah. Well, Miss Dionne, thank you so much. Everybody, please do your best to remain as safe and as healthy as you possibly can. Um, it would be, if there's anything that I can do to help in any way, please don't hesitate to reach out. As I always say, it would be such a shame that I have these relationships with folks like Dionne, that we have these relationships and not share it with everyone. And so that's the beauty of lending with purpose. Dionne, again, I appreciate your time today. And everybody, I'll see you next week.
Bye bye.